Well, hello. It's very good to be back with you. I'm Nicholas Bohnsack, President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Last week, my partners Jason Trennert and Dan Clifton took you through an in-depth preview of the U.S. elections. And while the process to determine the winners unfortunately appears to have shifted into the courts, and it may be some time before we know the final political results, as the last few days of market action have shown, investors are generally pleased with the range of possible outcomes. So what should we be focused on? Well, first, in the short term, let's not discount the possibility for an uptick in volatility. While the market appears to like the idea of divided government, it certainly also likes the idea of certainty. The longer it takes to certify the winners, the more impatient investors may become in bidding up stocks. We take the recent move in equities for what it is, a natural and welcomed reaction to narrowing the range of election outcomes to an acceptable few. Don't be afraid to buy the move, and don't be overly concerned if we see the market pull back. One reason to definitely not be concerned is the general strength in third quarter data. The more we see of it, the more we're encouraged by the general momentum in the economy. Most recently, U.S. manufacturing PMIs surged to 59.3, which is a really good indicator of corporate profit strength. And in line, 86% of companies have reported earnings above expectations for the quarter. In addition, unemployment claims continue to trend lower. Consumer spending has ticked up, and citizen mobility has increased. It means we're getting out there, we're moving around. While we still view the economic recovery as fragile, and the provision of additional fiscal stimulus would be both welcomed and supportive, it appears the U.S. economy is healthy enough on its own to weather any latent political storms. While the strength in the third quarter data have been encouraging, we're not quite in a full synchronized recovery either. Activity in China and broader Asia, where the virus appears to be under control, have been quite robust, though Europe and the UK are decidedly weaker as they suffer through a notable uptick in cases. And this leaves us rather comfortable in both our global and US equity positioning. With a clear preference for equities, we remain tilted towards domestic growth shares, while recognizing the growing opportunity in the emerging markets, particularly the service-oriented economies of South Asia. Within the United States, our preference is to maintain a gradual rotation towards more cyclical positioning while the economy improves. We have without question seen a broadening of market leadership in recent months. Stay focused on materials and industrials, those are two sectors we're overweight, and consumer names, particularly the relationship between discretionary and staples, to see if these trends hold. As we turn for home this week, one question from the Baird Mailbag stood out in the sea of submissions about the U.S. election. When can we stop worrying about the virus? Well, we're certainly not epidemiologists, but our North Star can remain a cure. While increased point-of-care testing has certainly eased the burden for many, the uptick in cases, particularly throughout the Midwest, reminds us of the importance of patience and vigilance. We'll get there, and we'll get there together, though it may take some time. If there's anything the Baird team can do to be of assistance, please be sure to reach out and let us know. Stay healthy. Thank you for your time. We'll see you again next week.